Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Surbhi Upadhyay. And there are nerves, there are jitters, there is some anxiety as we enter into the last leg of the election verdict. The Nifty is down below 22,750. It's a 150-point cut. We had a gap down opening, but things have fallen and got deteriorated a bit in the last 1 hour. So 0.6% gone in the benchmark indices. The Midcap index in the red now. Bulk of the selling pressure is coming in on the banks. The Nifty Bank is down a good 1 percentage point, with names like an ICICI Bank, Axis Bank and HDFC Bank staring at a cut of 1.5%. Even the life insurance companies are reversing yesterday's gains. So yesterday, the top gainers were SBI Life and HDFC Life, but today they are the top two Nifty losers. So big cuts, deep cuts coming in on SBI Life and HDFC Life. Pull up the Nifty PSU index to see the kind of performance and whether there is some profit booking visible there. Well, the PSC index is just down close to about 0.25%. So not too much by way of a cut, but oil and gas companies, so whether it's ONGC, BPCL, are under pressure today. L&T is a heavyweight, which is weakened in trade, and Reliance Industries is struggling for the third day in a row. Reliance Industries has a cut of close to about 0.6%, but in the last 3 days, it's lost close to about 2.5%. Lots of individual stocks outside of the Nifty are reacting to news flow. So Campus Activewear is now up close to about 16% on the back of strong numbers. So 15% up over there. On the way down, MTAR Tech 9% lower, EIL, Linde India. These are stocks where you can see some of the gains being shaved off. But let's get to one of the big movers on the Nifty, and that's Hindalco. This is after the company's US arm Novelis has filed for an IPO on Wall Street. Nigel joins in to explain the post-listing impact and how the valuations stack up. Nigel, morning, and also just throw in what brokerages have to say about this particular development.
Well, that's right. Hindalco's in focus because Novelis has come out with a few more details with regard to its IPO. So run you through the basic details. They're talking about a price band of $18 to $21 on a per share basis. The total dilution they're looking at is around 7.5% equity. How much will they raise? Well, they raised close to around 6,700 crores to around 7,800 crores. That's in rupee terms, going by the 7.5%. How do valuations stack up? Well, it's at around 10.8 to around $12.6 billion. That's the equity value. But you need to add the debt, which is around $4.3 billion. So in totality, the total enterprise value that they're asking for is around 15 to around $17 billion. Now, how do the valuations shape up? Going with a EBITDA number of roughly around $2.1 billion that they can do at Novelis, and going by this EV of around 15 to around $17 billion, then the valuation that they're asking for is a little over 7 to around 8 times EV upon EBITDA. The market is ascribing a number of around 6.5 to around 7 times EV upon EBITDA. So in those terms, it's good because they are asking for a bit of a premium and they'll get it in all probability as well. The clarity that the street is waiting for is what does Hindalco do with around the 7,000 crores odd, because they are the ones who will get the money. And most brokerages, they believe that they'll announce some capex here in India. So clarity on that front is awaited. Now, the stock price, if you just pull up the last few months chart, you'll see that in February, it was around 520 rupees. And that's when they first announced about this IPO. So the stock has already rallied close to around 25%. That's why it's not running away from current prices. The other problem for them is now there'll be a holding company discount that will be attributed because Novelis will be listed. And since Novelis will be listed, then the FIs who have more than 25% of the stake in the company, they'll say if we want to play Novelis, we'll go directly and play Novelis on the listed entity. So that's why the stock is not running away, because of the holding company discount, because the FIs have another option, and because it's run away already a goodish bit. What are brokerages making of it? Well, we have a call coming in from JP Morgan as well as CLSA. Both of them are optimistic on the prospects of the company, and they have ascribed a target price of around 750 rupees per share. Back to you.
Okay, Nigel, thank you so much. That's really helpful because that explains why Hindalco is not on a tear today, though the parent is going to be earning almost $1 billion with this IPO. Thank you for joining in with that.
Just one more point. When this initially, when this news hit the markets, the street was a little bit worried. Hindalco is raising money. Will it make its way into Vodafone Idea? But Vodafone Idea itself now has got the required money.
Settled.
So that risk is out of the way. And the management as well has said, no, there's no possibility on that front. So the street will be breathing easy see that they're raising this money. In all probability, it'll be for capex for the aluminum business.
Okay, so looking good and all set for this mega IPO in the US. And thank you for that, Nigel. Let's now look at some interesting result reactions, and got some very stark ones coming in. So we're picking out two stocks for you. One is Campus Active and the second is MTAR. Let's start with Campus Active. Now, this stock is up almost, look at that, 17%. Let's straight away go to Mangalam. I don't know, they've got rockets in those shoes, Mangalam. What's going on?
Well, they got rockets in the margins for sure, not their shoes so much, because, it was a 4.5% sort of revenue that the companies posted. But also need to know that Campus as a stock, was much loved earlier when it listed. Thereafter, it was also, much bashed as the growth came down, and it fell a fair bit from the high. Still, after a 17% rally, it's a good 15% away from its 52-week high, let alone life high. The good part is that there are signs of recovery. That's exactly what the street likes here. 4.5% revenue growth. The EBITDA has actually grown a lot higher, and as a result of which there's been 130 basis points improvement in the margin, and the net profit for the company has increased by about 40%. What's important is the internals of the numbers, where the company said the last couple of quarters the business has picked up because of their channel mix and they having focused on trade distribution. Secondly, the average spending price or average selling price per shoe has also increased marginally by about 0.5%. And thirdly, more importantly, they will stand to benefit from the BIS norms in India, irrespective of the near-term disruption. Their balance sheet has strengthened. They've repaid about 156 crores of debt and also reduced their working capital days from a little under 110 to a little under 80 now. So all these factors doing well for them. Kotak, in fact, has written on Campus as well. They believe that, they have an ad rating on the stock with a good beat on profitability is what they've seen, a target price of 285 rupees. They believe the volume growth is 4% and the management commentary is pretty strong. The management is confident of reverting to about double-digit revenue growth with margins between 17 to 19%. So if all these things were to happen, maybe glory days for Campus would come by.
Okay, and just to remind our viewers of the glory days for Campus Activewear, the all-time high on Campus Activewear was 639 rupees, and now the stock is sub 300 rupees, which means more than a 50% fall from its all-time high levels. So let's see whether we can go back to those levels. For now, Campus Activewear is excited, and it's trading at about 50 times FY26 PE. So that's the valuation on that. But let's talk about Paytm, that's locked in an upper circuit after sources say Vijay Shekhar Sharma has reached out to potential investors to buy a stake in OCL. Ritu joins in with the details. Ritu.
Well, that's right. We've been given to understand from sources that Paytm's founder Vijay Shekhar Sharma has been engaging in talks with potential suitors to acquire a stake in 197 Communications, the parent entity of Paytm. And one of those suitors that Vijay Shekhar Sharma has reached out to is the Adani Group.
I think we've just lost that connection with Ritu. We'll try and get her back because that's been the hot story since morning. Is Paytm, is the parent entity 197 Communications. Will it manage to get a new investor on board or not? We'll just try and connect with Ritu once again to get the latest on the story. Let's, in the meantime, focus on the other stock. Okay, before we get to the other stock, I think we have Ritu back. So Ritu, go on. Let's start from the beginning. We lost you there.
Well, we understand from sources that Paytm's founder Vijay Shekhar Sharma has been in talks with potential suitors to acquire a stake in 197 Communications, and just one of those several suitors is Vijay Shekhar Sharma, is Adani Group, who Vijay Shekhar Sharma has sounded out, but there is no clarity on the status of these discussions or any confirmation whatsoever, if at all they are going to fructify. It also remains unclear so far on whether Vijay Shekhar Sharma is looking to sell stake or one of the other investors in 197 Communications. If you look at the shareholding pattern, Vijay Shekhar directly holds 9.1% stake with another 10.28% stake, which is held by a firm registered by him called Resilient Asset Management in Netherlands. Now, if you recall, last August, Paytm had announced that Vijay Shekhar would acquire this 10.28% stake from Chinese investor Antfin through an off-market transfer, where Resilient is going to issue OCDs to Antfin without any actual cash transfer. So Antfin continues to hold these OCDs, which it can choose to redeem or convert at a later date if it so wishes, depending on the contours of the agreement between the two parties, which have not been made public. Antfin separately continues to hold 9.8% stake in OCL. Other key investors include SEF Partners, 15% stake, the company's directors, 9.3% stake, and so on. Now, a quick word on Paytm Payment Bank as well, where OCL, of course, holds 49% stake. There are, we understand, no talks to sell any direct stake in the bank yet, and until all customer deposits in the bank and wallet are fully moved out, even the regulator is unlikely to proceed with any next steps or any action otherwise. The Adani Group has called these reports of acquiring any stake in OCL baseless and false, while Paytm clarified to exchanges that the company is not engaged in any such discussions.
Okay, thank you very much for that. Let's get back to the earnings reaction then. MTAR Tech is under severe pressure. The stock is down 8% in trade. Upasana joins in to tell us what went so wrong with MTAR Tech and what the management had to say. Upasana.
Company has registered weak set of numbers both in Q4 FY24 as well as FY24 on a full year basis, and has also missed its FY24 guidance given by the company. In terms of Q4 FY24 performance, the revenue was down about 27% on a one-year basis, and margins were also under pressure at 12.7% versus 25% on a one-year basis. The PAT stood at 4.8 crore with a downtick of 85% on a one-year basis. And coming to company's full year performance, that is FY24, the revenue saw flat growth at 581 crores versus the growth guidance given by the company, that is around 610 crores. In terms of EBITDA margins, they stood at 19.4% versus the FY24 guidance shared by the company, that is around 24%. PAT stood at 56% with a downtick of 46% on a year-on-year basis. While the company has also cut its FY24 growth estimates, the revenue growth the company is guiding for now is 30 to 35% versus the guidance of 50 to 55% given earlier. The company has also cut its EBITDA growth as a guidance for FY25 to 21 to 23% versus 26% given earlier post Q3 FY24. While the company says that the company has registered lower than estimate EBITDA as the operating leverage was lower due to deferment of orders in the clean energy segment and delay in execution of projects in space segment. It has also highlighted that company is under discussions with some of the major MNCs in aerospace segment, hence it is expecting a significant orders shortly.
All right, got it, Upasana. Thank you very much for the details over there. So MTAR not having a great quarter. We will take a break on that. We'll come back on the other side and we'll get you the latest cues from the commodity markets with Manisha Gupta. Welcome back. As promised, let's now talk about the commodity markets and figure out what the headlines there are looking like. Manisha is joining in, and today she is joining us to talk about coffee. That's a great topic, Manisha. I hope you're going to tell us that prices are going down.
Well, I'm not. Actually, when you look at the last 24 hours, we're looking at most of the soft commodity prices gaining. So whether it's about cocoa, sugar or coffee, we have seen commodity prices gain up in the international markets. I want to talk about coffee, though, because we've seen the best performance really come in from here. We've seen 5% of gains overnight, and the coffee prices are trading at a one-month highs right now. There are concerns on the dry weather in Brazil and Vietnam, couple of major producers, and that has been supporting the prices, especially when it comes to Vietnam. The 2024-25 crop is anticipated much lower at around 24 million bags, which is a 13-year lows onto that one. Also, the global Robusta deficit has just about continuing for the fourth year in 2024-25 as well. Last year was a 9 million bags of a deficit. This time around as well, it's a deficit, though slightly lower than last year. But as I said, it's a fourth year of deficit at around 4.6 million bags there as well. For the Indian markets also, we are looking at higher coffee prices. Well, actually, when you look at the Robusta prices in India, they hit an all-time high on 29th of April at 225 rupees a kg. And we are holding around between this range as well. The farmers, while of course are getting all-time high prices, but the crop situation is not so great. There has been no rain really in the month of May for many of the coffee growing areas. So we're looking at lower crop, lower yield as well. So the higher price is really not compensating for that.
Okay, thank you very much for that bad set of news for coffee lovers like me and Surbi. Thank you for that. Let's get into a break. On the other side, we'll be joined by the management of Rashi Peripherals to discuss their Q4 earnings. Stay tuned. Welcome back. Let's invite the management of Rashi Peripherals on our show now. Now, this is a company which is a pan-India distributor for a lot of, tech hardware. So laptops, routers, for brands like Dell, HP, Lenovo. They also, have desktops, CPUs, motherboards. They also have certain lifestyle accessory products like fitness trackers and gaming accessories. It was a recent listing. The company listed in February where they raised 600 crore rupees. The company reported their Q4 numbers recently. And on a year-on-year basis, while, the revenues have expanded quite significantly, margins have been slightly under pressure. For the full year, the company has clocked in a top-line growth of about 17.5%. To talk about the way forward, we have with us the company's MD, Kapil Suresh Pansari, and the CEO, Rajesh Goenka, to take a few questions. Thank you very much, gentlemen, for joining in. This is Rima here. Kapil, if you could first talk about the top line. For the full year, you've ended with a 17.5% revenue growth. I remember a conversation during the IPO where you said that this is a company which has been growing at 20% for the last 2 decades. So in that sense, do you think FY24 was slightly lower than expectation? There were certain headwinds. And what can you guide for FY25? Can you get back to a 20% plus run rate?
Right. So, Rima, thank you for having us. What I would like to say that during the COVID years, the market grew by almost 25% year over year for FY21 and FY22. Post-COVID, when the offices, the schools opened up, obviously the technology and the demand cannot sustain the same level of PC requirement. So therefore, there was a little degrowth. So in FY23 and FY24, there was a little bit degrowth by about between 6 to 7% market. What we are seeing for the last 2 quarters, the demand has started coming back up. And consumer market especially has clocked last 3 consecutive quarters growth year over year. So we see that the demand for the PCs are coming back on track. And despite the degrowth of the market, Rashi Peripherals have grown by about 17.4%. So that's from a market point of view, we've grown faster and larger market.
So can you tell us? Yeah.
For FY25, forward-looking, as the demand is coming back, this year is going to be transformative for the PC industry, primarily because there are a lot of companies from all our OEM partners like HP, Dell, Lenovo, Asus. They will all come out with a refreshed PCs, which will have AI-enabled capabilities, which will do complex tasks, analytical data, spreadsheets, etc., which will drive a higher productivity. Now you can imagine once you have these capabilities, the people will want to be far more productive. They would want to refresh faster and higher. So therefore, we would expect that this year will definitely come back on track, maintaining a CAGR growth.
Mr. Goenka, hi, let's get you in the conversation as well. If you could expand on that point. Sounds very exciting. AI-enabled hardware, right? AI-enabled perhaps laptops and PCs as well. So again, just going back to the numbers, if you've grown a little over 17% this year, and with this whole AI push, what is the top-line growth expectation that you can share with us for the current year, FY25, and break that up between the enterprise segment of your business and also the consumer segment, the peripherals out there?
So I'm not at the liberty to give you a next near number, but I can only tell you that, as Kapil also mentioned, last 20 years, our CAGR has been 20%, one. Second, last year, the entire market degrew by 6%, but Rashi Peripherals has grown by 17%. So indirectly, we've had a 23% growth on a YOY basis. continuing on the same trend. Now the market has normalized, so we hope to continue our trend. And the best part for us is, as we have already declared in February, that Rashi Peripherals has won one of the foremost and the largest AI cloud data center order worth 1,510 crores. This order we bagged in the last financial year, but the execution has already started from April onwards, and in the current financial year, that execution will happen. So this will result in having more than 100% growth in our enterprise vertical. And our regular business, where the business is going to be as normal, we obviously will have double-digit growth. So I think this answers your point of overall growth trajectory in the coming year.
No, the reason actually, I mean, sure, for the enterprise segment, I understand because that NMDC order is a massive one for you, and that's where the revenues will start kicking in. But for the lifestyle segment or the personal computing segment, I wanted to understand what is the normal run rate. I mean, you give us a revenue run rate of about 23%, but in general, what is the normal growth rate of the business industry-wide? And then since there's this AI element to it as well this year, whether that could be substantial higher, 20-30%?
Yeah, so in general, the industry growth this year is expected to be lower double digit, so somewhere around 10-11%. But with Rashi Peripherals being a value-added distribution company with the reach that we have, we always aspire to grow 2x of the industry average, and that is what we have been successful so far. And with the strategies in place for the coming quarter and the entire year, we are very confident to maintain our trajectory.
What's the contribution of the enterprise business for you right now, Rajesh?
Sorry, can you repeat the question?
What's the revenue contribution of the enterprise business for you right now?
So currently,
and how much will it
currently the enterprise business is roughly about 10 to 12%. But with more than 100% growth, this percentage is all bound to grow because that's where the major acceleration growth will come from. But at the same time, I do not want to discount any of our other businesses because they also will continue to grow. But of course, on a larger base.
So just to understand that 10 to 12% of your business is enterprise, which is going to grow at more than 100%, while the balance is consumer, which is split into personal and lifestyle, and that together will grow 2x that of the market, which is about 10 to 11%. Are we getting the numbers right?
Yeah, maybe you can assume that.
Assume that. Okay. Kapil, tell us about the margin decline in Q4. What led to that, and what can you guide on margins for next year?
So the margin decline primarily is on account of the inventory and working capital costs that we had to incur. If you see, we currently raised the 600 crores in IPO in the middle of the quarter. And over time, as the inventory cycle correction that started happening from Q3 onwards, the working capital cycle demanded a lot of investments from a capital deployment perspective. Our average working capital cycle remained between 57 days, and that was the major reason. While the growth comes back on track, we assume and we predict that this cycle will definitely have a scope to improve further.
But Kapil, just just to follow up on that, when you talk about margins improving, what is the aspirational sort of run rate for you? As like Mr. Goenka also said that there'll be more value-added businesses, that even on the lifestyle side and personal computing side, all these AI-enabled devices. So, what is the aspirational target sort of margin band, perhaps that you can look at this year or the next year? And also, part B to that question is that does the enterprise segment, does that enjoy higher margins or lower margins than the consumer segment? I'm just wondering, when you execute a contract as big as the one you're doing with NMDC, basically if that's better margin or lower margin than the other business?
Yeah. So I'll answer in two parts this question. One, the aspiration value, margin earning potential for us is between around 1.5% PAT is what we aspire to achieve. This is very much achievable. We are working towards correcting the inventories. We are ensuring that optimized working capital cycles that will bring us to those levels. And a healthy debt equity ratio will ensure that our revenue growth does not hamper while we try to correct the inventory cycles. Inventory is a very key component because as much inventory we have is our ability to churn the revenues accordingly. So we have to keep a right balance between the two. The second part of the question that you asked is how do we ensure that the enterprise businesses will retain a stable margin or a lower margin? So from a percentage perspective, these large orders obviously does not entail to the same level of margins. However, the costs are far, far lower than what we are going to operate upon. Therefore, our operating leverage and the margin leverage is going to be higher.
Got it. Kapil, Rajesh, thank you very much for joining in. By the way, look at the stock react positively to the management comments. It was flat when we began the interview, and now it's up 1.5%. The management saying that the enterprise business will double in, will double in terms of its overall revenues, and even the consumer business over the last 2 quarters is showing signs of life. There is resurgence in growth, and the company appears to be confident about going back to their 20% plus top line trajectory. That's Rashi peripherals for you. We will slip into a break on that note. On the other side, we'll come back and talk market technicals. Sudeep Shah from SBI Securities will join in next.
Welcome back. Here with us on Trading Hour. Now, the giant Indian election is entering its last phase. CLSA has identified 54 companies in the meanwhile, which are perceived as direct beneficiaries of Prime Minister Modi's policies, and perhaps they could stand to benefit if there's political continuity. Hormaz is here with details of this interesting note. Hormaz, we're all ears.
CLSA has come out with a note. Now, they've identified 54 stocks, which they call, quote-unquote, Modi stocks, as they are expected to be beneficiaries of the current government's policies if it is voted back to power for the 3rd term. Now, what they also said is that 90% of these 54 stocks they've identified have outperformed the Nifty in the last 6 months, and which is why they have called these gains that the index has made over the last 6 months as an election-driven rally. Now, and they also say that this outperformance may continue if the current government is voted back to power with a strong mandate. Now, among the stocks, what are the stocks that they have identified within these 54? PSUs dominate the list, but L&T is one of them. Among the PSUs, you have NTPC, NHPC, PFC, ONGC, IGL. Now you go to MGL and the telecom players as well. Reliance Industries, Bharti Airtel and Indus Towers form this list as well. Now, beyond this election, but CLSA has a word of caution here. They're saying that this election-driven rally may come to an end in the month of June or July, and hence banks are the best risk-reward play for the second half of FY24. Now, beyond the Modi stocks, the picks that they have highlighted include the financial names like HDFC, Axis, ICICI, Bajaj Finance, Zomato and Avenue Supermarts as well. Now, once this rally comes to an end, what CLSA says is that investors may get a bit of a reality check, as most of the positives are already baked into most of these stocks, and as a result, this may result into some profit booking among these Modi stocks, which for people who are less patient and less patient holders of these Modi stocks. And they are also highlighting a similar trend over the last 2 elections in 2014 and 2019, where PSUs had topped out within a few weeks of the election result, and here they are expecting a similar phenomenon to take place in June and July. So 54 stocks that CLSA has identified, but the bigger trigger is that the PSU rally may see a bit of topping out in June or July.
Okay, thank you for that. But you also looked at the Nomura note, which has surveyed 150 investors on what they think is going to be the outcome from this year's elections and what the possible market impact could be. Tell us about that.
So the outcome of this investor survey is pretty clear, Rima, is that 99.3% of the 150 investors who were surveyed by Nomura believe that the BJP will win this election in 2024. Now, how many of them believe that the BJP will get a majority on its own without support of its coalition partners? That is 83%. Now, there is also a bit of division on how many seats will the BJP win in this election. Now, there has been a lot of opinion, a lot of numbers that have been thrown at us over the last 24 hours. Here, 45% of the surveyed people believe that BJP might get fewer seats compared to 2019, while 36% of them believe that they would better their 2019 tally, which was 303 seats that the BJP had won. Now, In overall terms, if you see among the analysts, among the surveyed investors who were surveyed, they expect the BJP to win 297 seats as a cumulative figure, and the NDA to win 344 seats in 2024. Both of them are slightly lower than the 2019 tally. Now, what does this impact? How does this election result impact the economy? Now, the medium-term GDP growth is seen between 7 to 8% if the NDA returns to power for the third term. However, they are expecting this growth to dip to 6.5% if the India Alliance is voted to power, and they also expect major fiscal slippages if the latter happens, although they say that the latter is a very unlikely possibility. Now, what is the market factoring in? The survey believes that the market is factoring in an outright victory from the BJP, and any different outcome from this, what the market has factored in, could be a negative surprise, and a decisive BJP rally in this win in the exit polls can drive a short-term rally on the market. Now, the sectors that may benefit, they are expecting infrastructure, capital goods, defense to do well, as is the sectors that the government has laid a lot of emphasis on over the last 5 years as well. Now, the market impact, as we said, that the street has mostly factored in a BJP win. So Nomura believes that if that happens, it will just be a low single-digit rally on the index on the post the 4th of June. However, if the BJP wins and if the NDA government comes to power without a BJP majority, they expect the market to correct 5% from current levels. And if the BJP cannot form a government even with support of the NDA coalition partners, they expect the market to correct up to 20%. So all in all, the street is factoring in a BJP win. All eyes are on the 1st and the 4th of June.
Okay, all right, indeed they are, Hormaz. Thank you very much for that summary of both of those very interesting notes. Well, as we await the 1st and 4th of June, we have a trading session today to deal with as well. So let's get back to it. Sudeep Shah of SBI Securities is with us for a quick technical check on the market. And as we say hi to Sudeep, the cuts are getting a little deeper. Pull up the Nifty. Let's do that because we are now looking at a 160-point drop on the index. And the bank Nifty is leading that decline with about a 1% dip. Midcaps also under pressure. Sudeep, hi. So it's very clear the nerves are showing up. There's a lot of profit taking that started yesterday. It's continuing today. What is your advice as we look at just 1 to more trading sessions ahead of the event?
Good morning, Surbhi and Rima. See, what we've seen in the last few sessions is that post indices touching a high of 23,100 levels. We have seen some kind of a negative momentum profit booking from higher levels. And going forward, what we expect is that with the large caps now witnessing some kind of pressure today, the key support levels of 22,600, 22,650 zone could get tested in the next few sessions. And that is where the 20-day exponential moving average is also placed. So I guess 22,600, 22,650 zone could act as a strong support on the downside. And on the upside, the resistances are now well placed at 22,850, 22,900, and that is where the maximum call writers are also placed. The highest open interest is there. So I guess it would be Nifty would be trading in a range between 22,600 on the downside and 22,900 on the upside. And only one thing what I feel is now going forward in the next few sessions, we should not be too aggressive from a trading standpoint. From an investor standpoint, it's okay to accumulate good quality stocks, but going into the event, over leveraged positions should be avoided.
Okay. Quick word on the stock specific calls that you would recommend.
Yeah, so there are a couple of stocks which I like now. The first one is Sumitomo Chemicals. Day before yesterday, the stock has come out with numbers, and the numbers were excellent. Along with that, technically, if you see, the stock has given a downward sloping trend line breakout and is also now sustaining above 453 levels, which was the prior swing high of September 2023. And apart from that, it is witnessing outperformance when the broader markets are under pressure. So I feel this stock could be bought with a 455 stop loss and a 485 as well as 495 targets on the upside. Another stock which I like is NCC. Now, this stock is in a structural uptrend with positive momentum visible across all time frames. Along with that, last few days we have seen the stock was witnessing consolidation at higher levels, and today it has broken out of that consolidation zone. In addition to that, it is sustaining above 278, 280 zone, which is the previous swing high of April 2024, and now that could act as a support in the next few sessions. So till the time the stock holds this level of 278, 280, this could be bought for a target of 310 on the upside.
Okay, all right, Sudeep, we will leave it over there. By the way, those are interesting lines coming in from the NMDC call. NMDC itself has picked up a little bit from the lowest levels of the day. Two interesting aspects there. One, they're saying that the royalty payout is going to be lower this year. As a percentage, it's coming down to, I think, 43% from 47%. And the second is NMDC Steel could break even as early as the second quarter. So, yeah, NMDC Steel that's NMDC. Let's pull up NMDC Steel as well and see what that stock is doing. The parent company is guiding for a break even by the second quarter. Well, with that, let's slip into a very quick break, come back on the other side, and we will be in conversation with Rakshit Ranjan of Marcellus. Welcome back. As promised, let's get that conversation going with Rakshit Ranjan of Marcellus Investment Managers. Rakshit, welcome to the show. Thanks for joining in. So, the heat is on in the air, in the atmosphere, and in in the political field as well, as we are racing towards the 4th of June event. So, tell us, I mean, in this whole run-up, the market first fell, and then there's been this rally to fresh all-time highs last couple of weeks and months. What changes, if any, to the portfolio? What have you guys been up to?
Yeah, thank you for having me on the channel, first of all. Yes, we are also closely monitoring the progress of the external environment in the last few months. We've made significant changes as we sort of rev our portfolio more towards high growth. We've added 5 or 6 stocks in the last 6-7 months, which is an unusual run rate of new addition. Largely speaking, we are oriented the portfolio towards companies where reinvestment rates of their cash flows are very high, 80 to 100% in many cases. So, for instance, whether it be some of the relatively low valued companies like say a Narayana or an Eicher, these have been 2 additions, or many companies such as say Tube Investments or Trend, where there are multiple optionalities that the businesses are throwing up, which are not fully baked into the price. In effect, grabbing many areas of upside earnings growth generation that are not in the price through many of these changes.
So, Trend, Tube Investments, and can you tell us which are the others which have found their way to the portfolio over the last couple of months?
So in the healthcare plus health insurance combination ecosystem, Narayana Hrudayalaya is one stock we added, and the sort of rising energy of premium two-wheelers that we can see in Eicher Motors, we've added Eicher as well to the portfolio.
Got it. In your Kings of Capital portfolio, you've also built a position in Motilal Oswal. Now, we all know that capital market-related players are doing very well, whether they're brokers, asset managers. But the question is only about the value from here on, considering stocks like Motilal Oswal have already gone up to 50% in the last 1 year. So when you decided to make that addition in the last 1 month, can you tell us how you assess the past performance and how much of it is already in the price for these capital market-related players like Moti?
Yes, so Kings of Capital portfolio has a slightly different portfolio construction approach than, say, consistent compounders. And in that regard, it was a few months ago that we added Motilal. We've actually managed to benefit from a bit of the upside, a lot of the upside that has come through in the last few months. The idea there is if we can't see the abatement of these capital flows into the broader markets, Motilal becomes a very strong play. This is not the consistent compounding type of stock selection under Kings of Capital that we've done. It's a relatively smaller allocation meant to benefit from the increasing capital flows that we are seeing in the financial space.
Interesting. That's really interesting. So it's a slight departure from the usual philosophy, right, at Marcellus, which is looking at consistent compounders, growth in ROCE and the other parameters that you have. Anything else where, I mean, you're willing to look at maybe a slightly shorter term trends and willing to ride them? The Motilal example you gave, anything else that's looking interesting to you right now?
No, not really, and also it's not a departure from that philosophy. So we've got different schemes with different approaches. So, for instance, when you look at our rising giants PMS, there's a lot of, or little champs even more so. There's a lot of discovery element that we try to capture there. Before a stock would enter into BSE 500, can we discover it before the rest of the market, as a result, discovers after the entry into the broader index? So that's very different from consistent compounders. Similarly, Kings of Capital plays largely the financials piece only. It wouldn't invest outside of financials, and within financials, then portfolio construction includes the bulk of the allocations being towards consistent compounding types of financial services businesses. At the same time, if there are certain tailwinds that in some areas in high quality businesses that we can benefit from without compromising on the quality of the franchise, those are the calls that we've taken.
Okay. Any positions, any stocks where you've trimmed your positions?
Yes, so there are a few names where, in a relative way, we expect relatively lower earnings growth. So, for instance, say an HDFC Life versus some of the additions that I've talked about, there's a big 5-7% delta between the expected earnings growth rate of those two types of categories of stocks. So it would be HDFC Life. We trimmed a little bit. Given the weak consumption macro from a couple of consumer stocks, we have trimmed a little bit. We haven't fully exited, but we've trimmed a little bit from some of the macro affected sort of small ticket consumer company names. Kotak, we had exited a few weeks ago, replaced it with Chola, in fact, in the portfolio on the lending side. So those would be some of the areas from where we've taken money off.
You fully exited Kotak, and this was post the RBI diktat from consistent compounders.
Correct.
And what was it? The RBI recent diktat which made that decision for you?
Correct, because for the next 12 months we expect the earnings growth at Kotak to be a lot weaker than otherwise, and as I said, Chola much better earnings profile. Hence, it has been replaced.
Okay, all right, got that, Rakshit. Good chatting with you. Nice conversation as always. Thank you very much, and we look forward to the next one. Okay, with that, let's take a break and quickly come back to our next conversation. And we'll be putting the spotlight on the banking and financial sector space. We'll talk about the trends that have emerged after the Q4 earnings season and the outlook ahead with Santanu Chakrabarti of BNP Paribas. Welcome back. You're with us on Trading Hour, and as promised, let's quickly dive into BNP Paribas' view on the banking sector after the Q4 earnings season. We have Santanu Chakrabarti joining in for this. Santanu, I was looking at your report. It's titled very interestingly, saying a season of overlooked positives. So tell us, what are those positives? I mean, from what I recall, the thing is, we went into the season with this big sort of hoopla around the margins will start compressing and major margin compression will happen. But I don't think we've seen too much of that. I mean, that kind of a negative surprise didn't come out. But you tell us your takeaways and what prompted changes, if any, in terms of your recommendations.
Right. So you have absolutely nailed it. When we went into this result season, the market narrative was that there's not enough deposits around to sustain the kind of growth that some of the larger banks had to deliver on. Especially the case of HDFC Bank comes to mind. And also, of course, whatever little deposits were available were going to be very, very expensive and therefore would have a concomitant impact on margins. Now, against that, what happened? Out of the 6 largest banks in India, if you look at, 5 of them delivered positive surprises in the quarter. And the one which delivered a minor negative surprise, which is HDFC Bank, which was about 2.5% below, in earnings terms below where the street was. It was only on raised expectations past their early release in the beginning of the month, right? So they do this pre-quarterly release where the market already knew about that 1.67 lakh crore deposit number, and the stock had positively reacted to that also. And on those raised expectations, there was a minor disappointment. You go into the, what structurally made up the delivery of the earnings for each of these banks for the quarter, and you realize that in none of the cases have the margin squeezes been very material. B, management in each of these cases have come out and been quite clear that they do not expect a lot of incremental pressure on cost of funds. It's not as if cost of funds are going to reverse anytime soon, but the bulk of the re-rating upwards or repricing upwards is already done with that. No pressure on cost to assets, operating costs, especially in the case of, for example, SBI delivered a positive surprise. But against all of that, we are speaking today and private banks are down again after this mini rally we have had for the last couple of days. And the market seems to be completely looking through the numbers, even, positive surprises being delivered on those expectations, valuations being as attractive as they are. And we have been crying hoarse about this, as you know very well, Shubhi. But it is what it is. And, we expect at some point the penny to drop for the market on the entire sector.
Okay, perhaps the pendulum will swing. Shantanu, morning. This is Reema here. We were just chatting with Rakshit and he said due to increased regulatory headwinds, they've completely exited their holding in Kotak Mahindra Bank in their consistent compounders portfolio. This was Rakshit Ranjan from Marcellus. Yeah. What did you make of what the management had to say in the conference call? Because when they quantify the impact, and I think at about 350, 400 crore at a PBT level, it doesn't amount to much. Are you a bit worried? Yeah, it doesn't appear to be too much. So are you a bit worried about Kotak Mahindra Bank, and have you changed your assessment on the stock?
So look, we have never had a very constructive view on Kotak Mahindra Bank, purely on account of the fact that we felt that given the capital productivity that the bank has been delivering, and against the valuations at which the core bank is trading, even if you take out, whatever you want to value subsidiaries at, and we value it at about 550 rupees, around that, on a per share basis. You take all that out, it wasn't still a very cheap bank, especially in relative terms, relative to where HDFC Bank, ICICI, even ICICI is trading right now. But we had a neutral on it earlier, but we actually downgraded to an underperform on the news. And in our underperform note, which was actually put out way before the call happened, we actually came to the same conclusion that the management has come to, that the incremental direct economic impact of the change is not very large. But here's the problem on which we downgraded to underperform. The problem is this, that right now to fix that capital productivity issue, Kotak Bank needs accelerated growth. And if Kotak Bank's DNA has been studied by anybody over the last 1.5 decades, one thing becomes very clear, that they always, would err on the side of caution rather than risk at any point in time. So under the regulatory interventions that had happened, the probability of them delivering a growth number which is significantly ahead of, say, the ICICIs of the world, which is so critical to, getting their capital productivity up into, the upper teens on a core level, so that the multiple can be justified. It just became harder. So on that, we have put an underperform.
Got it. Yeah, I was actually looking at all your ratings right now. And indeed, I mean, if you're looking at 24, then Kotak at 3.1. Price to book, indeed, it's by no means cheap. I got that. So very quickly, Shantanu, we have only 30 seconds left on the program now. Your positive ratings are on Axis Bank, on HDFC Bank, even on an ICICI Bank, I believe, and on an SBI. Yes. You like all the four banks, but the maximum upside target to your target price is actually on HDFC Bank. Tell us your pecking order if... yeah, that's your top pick. So just tell us what might change and what makes you most optimistic?
So at this moment, if I look at the only risk, to the earnings trajectory for the banking sector, and since the focus is so much on earnings momentum, it is the timing of rate cuts, which is obviously very linked to what happens with US monetary policy. As of now, we are building in an October rate cut. And, the margin recovery story can really start in earnest only 1-2 quarters after the first rate cuts. So any delay in that is a little bit of a dampener on FY25 earnings, if not so much on FY26 earnings. So as of now, we see that as the key risk. More of a delay we have later, say the recovery on margins, ROA, etc. for HDFC Bank becomes, and more favorable we become towards, say, something like a ICICI Bank. That's how we are positioned. We see that as the only risk. But given where the valuations are, even another 2 quarters of delay in rate cuts isn't exactly a deal breaker as far as the investment thesis goes.
Out of time. Thank you for joining in. With that, it's a wrap on Trading Hour. Thank you for watching.